Hi, I'm Michael Andersen, and for the next minute or two, I'd like to talk with you about how you can keep your money in your family and away from the IRS. I'm talking about retirement accounts. As many of us know, your 401k or your IRA grows when you're accumulating money tax deferred. In other words, gains, capital gains, interest, dividends, these things aren't taxed while the money is in deferral. But in retirement, when you take the money out, that's when you pay tax on it. Well, what happens when you have one of these accounts and you pass away? Well, of course, on these accounts, we name a beneficiary, someone or a group of people who are going to receive the money, and when you pass away, that recipient has to make a decision. There are a couple of different decisions, but the two most common are they going to, quote unquote, cash in that retirement account? The IRS will get the government's fair share, and your beneficiaries will get the remainder. Or do they want to not do that and create what's called an inherited IRA? Well, an inherited IRA may be right if the beneficiary really doesn't need a big lump sum to spend right then and there. And the way it works is the money remains tax deferred. But if you were over the age of 70 and a half, then the beneficiary has to take distributions. They're called required minimum distributions. But the neat thing is, in most cases, the amount of the distribution, the percentage rate, is based on the younger person's life, not necessarily yours. So it's entirely possible to defer taxation even further and keep that money away from the IRS. It's definitely a somewhat complicated area, so please make sure before you make those decisions that you speak with a qualified professional or accountant so that we make sure we don't give money to the government unnecessarily.
Money Insider is sponsored by Andersen Wealth Management.